You are listening to the Marc Guzman podcast experience.
So we're going to get into the very first topic here and talking about what's been making news lately. And it's really the person who has made $1 billion in losses. And this is mind-boggling, but our President Trump, his tax returns from the 80s and 90s, I think from 85 to 95.
1985 to 1994.
1994. So 10 years worth of tax returns. And he used up almost $1 billion in losses.
Actually, $1.17 billion in losses is what he says, in real estate losses. And as a matter of fact, so a lot of what's boggling people's mind in this is, one, is he that poor of a business person that he lost that much money? And then the other question, of course, is how do you lose that much money and still stay in business? Right.
One of the arguments that he quickly and some White House administrative officials came out with is, oh, well, in real estate, you get depreciation and you can use depreciation in order to write off additional losses. These are paper losses, not actual losses. And that's the excuse that they were going with in why he added up $1 billion in losses.
And I can speak directly to that. In fact, I'm a real estate investor. I'm a real estate an owner of real estate income, and I spend a majority of my time and the majority of my money is made from real estate, not just real estate sales, but collecting rents. And because of that, what Marc is referring to is that I can take an unlimited amount of depreciation on my assets. And to kind of give you an idea and this is the excuse that Trump is using, by the way. But as I read this, and I love to reverse calculate things. However, just going through the narrative of what he's talking about, it's hard to really sink your teeth into a specific property where you can pull the public records and then kind of begin to unravel it. But it looks to me as though that these were actual losses. And so to kind of understand, I'm just going to put a few definitions out there. So typically you'll hear people, even real estate agents, or people who are working for themselves, self-employed, 1099, they'll use write-offs. Now, write-offs are real actual expenses that you've spent during a 12-month period. And there's items that are expensable from the IRS standpoint, and then there's those that are not. And some people will push the limit as to what they can write off or expense. And all of that is so that they can reduce their bottom line as to what's taxable. So just making it really simple, you gross $200,000 of income and you write off $180,000 of expenses, right? And the IRS didn't audit you, you got away with it. And so you're only paying taxes on the net income of $20,000, right? Now, when you go to apply for a loan, they're going to look at you and you only make $20,000 a year. It's not your gross income. And sometimes if the IRS looks really closely at you, they're going to say, okay, these expenses are not allowable. And they might deduct off some of that $180,000, and then you're going to be taxed on a little bit higher amount. Now, that's not what's going on here from what I could see, because those are yearly expenses. Then there's also things like capital losses. So, for example, you buy a property for $200,000, you put $100,000 down, and then the market goes really bad. And I'm just using small numbers. These numbers aren't real anymore. These are like monopoly numbers. But $200,000, you put $100,000 down of equity, you expect it to go up in value. And if it goes up in value and you sell it, then you have a realized gain. But if it goes down in value and you're forced to sell it, and for less than what you bought it for, then you're going to have a capital loss. And that's a real loss of money. And in real estate, when they're doing large deals, as what Trump is doing here, like on casinos and things of that nature, Trump isn't necessarily playing with his own money. He might be putting in 10% of his own money, but the majority of that money is raised from limited partners, accredited investors who are putting in the majority of the other equity, all with the belief that this guy, who is the general partner, in this case Trump, knows what he's doing and he's going to be able to control their assets, placed in real estate, and make a profit, a capital gain. In this case, it looks like he took some serious capital losses. And so because of that, he's able to take loss carry forwards. You only do that with capital losses. Again, these are major losses that are typically equivalent of your down payment, right, on a property, as opposed to a loss of income, meaning the property was supposed to make 100 grand a year and it only made 80. So those are actual losses of income. And then, of course, the big thing that everybody's asking about is depreciation. And in real estate, you can take residential income property, that's like apartment building, and you can take 80% of that, divide it over 27 and a half years and depreciate that. But if you're not in the business of real estate, you cannot take that entire loss. In fact, the majority of individuals, if they're gainfully employed, working for an employer, or even self-employed in a different line of work other than in real estate, like a real estate developer or real estate investor owning buildings, you cannot take the depreciation, the unlimited amount of depreciation. So in all of these excuses that Trump is talking about, where he used depreciation or accelerated depreciation, where instead of taking the normal 27 years, you're able to do what's called a cost allocation study and distinguish the exact real life effective ages of big components of your building, right? Or asset, like the roof only has a 10-year lifespan. So you don't take 27 years, or you don't take the 39 years that you're supposed to take on commercial property. And like the plumbing might have a 15-year lifespan. So in essence, you're segregating out all these different costs and you're cutting in half the time frame that you would take those depreciation losses, which, by the way, depreciation, as Mark pointed out, is just a paper loss. So you get to add it back to your income when you go to apply for a loan. But in all of the descriptions that Trump is bringing out here, where he had real loss carry forwards that he was able to take year after year, these were actual losses of equity that he took. It's hard to distinguish how much of it was actually his, because in a typical structure where you have general partners and limited partners, Trump isn't putting in all his own money. So that means that 90%, 80% of that equity that was raised on a bad venture was from other people, and he may have only put in 10 or 15%. But when you're talking numbers that are as large as his, these are billions of or millions and millions of dollars of carry forward and losses. So this story just doesn't jive. I don't have all the big picture. It's got a narrative here. If he was just taking accelerated depreciation, which he would have been allowed to take because he's in the business and he's able to overcome more than what his actual taxable income on that property is, and because he doesn't have a limit, he can take that depreciation and apply to other places where he actually made money. So let me put that in perspective. When you take a building that says that makes 100 grand a year in net profit, but it has a $90,000 a year of depreciation straight line, you're only paying tax on $10,000 of that $100,000. However, if you can do a cost allocation or cost segregation study that takes these big components into place, you can almost double or triple that $90,000 a year. So now you might make that same $100,000, but you're writing off $190,000 or even $210,000. So you don't pay tax on that $100,000, and you might still be able to take that extra $100,000 to $110,000 of depreciation loss from accelerating your depreciation and wipe out additional income that you might have from other sources, like you sold a building that was not a rental, it was like a flip, or in his case, he would build new construction and then sold it off for a profit. He would have been able to apply that excess depreciation that an income generating asset would have had to ordinary income. And then he talks about tax credits. So after you've taken all of your different expensable items, the expensable items for the year that you're allowed, take your depreciation or accelerated depreciation against that income so that you are wiping out that taxable income. And let's suppose you still make more money than what your excess depreciation allows. Let's suppose you can take another $500,000 of income from the excess depreciation that you generate, and you made $800,000, right? So now you're getting taxed on $300,000 at whatever tax bracket. So in this case, probably 48%. So you'd owe $150,000 on that $300,000. Then you get to take tax credits for certain developments that you did. Well, in this case, all of these things that he's describing just don't seem to add up. It looks like he actually took real losses because he was able to carry them forward. They weren't accelerated depreciation carry forward, because you can't necessarily do that. You can only use it for the given year that you can apply for and can carry that forward. But again, the narrative doesn't really give the whole picture. So I think I'm gone way over my limit on this. Hopefully that kind of help, puts things into perspective on things, and we're going to try to go to the next topic. Marc,
Okay.
save me. I'm talking too much.